Hello everyone. Today we are going to continue our lesson from last time when we started talking about technical analysis, which is the second important tool to analyze markets and to predict the future markets. As we said in the previous class, technical analysis use the main tool for its movements chart. So we started yesterday with we started last time on the type of charts. Today we're going to continue with some other important tools that are used and helping us to predict the future movements of the market. As main target of technical analysis is to recognize the certain direction or trend, which we mentioned in the previous sessions as the key point in successful trading, and to predict the length, the strength, and direction of the trend, and possible reversal of the trend, which could be indicated by various tools that technical analysis use. So today we're going to talk about first about chart patterns. As we said, the chart is the key tool for technical analysis to predict the future movements. Now, there are certain patterns as the price moves in waves, not in the one straight line. The candlesticks form, the shape, trading the movements of the price forms certain shapes which are called chart patterns. So, as definition says, geometric shapes created by price movements of financial instrument, in this case either currency, commodity, or stock. And the patterns basically provide an information how the financial instrument is currently moving, and of course the signal the future direction and strength of the move that is going to come. Our picture shows various patterns, so we're going to go one by one to see what are the most important and how we can use them in order to analyze market and correctly predict future movements of the market of a given instrument. There are two main types of chart patterns: reversal patterns, those that signal change of the existing trend, and the continuation patterns that signal that existing trend will continue after certain session of consolidation, which usually happens, and we will see it in the our further chapters. So reversal patterns are chart formations that form at the extreme, highest or lowest points of the trend and signal that current trend is about to change its direction. Formation of reversal chart pattern during an uptrend signals that the trend will reverse to the opposite side, so downside, and the price will soon going to start heading to the downside or to the downside. If a reversal chart pattern is seen during the downtrend, it signals that the price turn up. So this is the opposite scenario. So we have in both directions reversal patterns that could be signaling that something is developing, and most likely the existing trend is going to change its direction. So a reversal, it could be anticipated in the near future. The popular patterns that we are going to talk about today start with the double tops and double bottoms. A simple pattern, but quite useful and quite reliable. The double top or double bottom pattern is formed after a sustained trend when the price tests the same support or resistance 2 or 3 times. I have to mention that there are also double or triple tops and bottoms, so it means the same. It's just depending how many times the price will be rejected before changing its direction. So when the price tests same support or levels close to it, not necessarily to be at the same level, or resistance 2 or 3 times without breakthrough, and then the subsequent bounce is forming the double top or double bottom pattern, and this is the initial signal that the current trend is going to reverse. We have a picture here which shows that we have an uptrend in the double top. So the price goes up, hits certain level, faces certain resistance there, and returns back, finds support in attempts to continue its trend, which happens up to a certain level, which is at or close the initial rejection level, and then goes down. Now we have to see the break below the neckline. Neckline is the line that connects 2 or 3 lowest points during that shape. So in this case, it's connecting 2 lows, and clear break of it will signal that the price is going to reverse. In this case, that uptrend is going to turn to the downside. So long positions could be in danger, and the traders need to take proper steps in order to protect their existing profits or to reverse position. Usually calculation goes 1 to 1 or 1 to 2, measuring the highest or lowest point of the pattern with the distance between the neckline and the highest or lowest points of the pattern. That extension could go, could extend. So we are talking about move from neckline to the top. One or two lengths of this is forecasted or predicted move. Double bottom is the same shape, just mirrored. So we have a downtrend that hits certain support and loses power there, bounces higher in order to reverse and continue lower. Continuation lower again faces strong support, and the subsequent bounce is forming a double bottom pattern, which will be again confirmed on the break of the neckline. And extension higher is expected again of the length of the lowest point to distance of the lowest point to the neckline, one or two lengths of this. Important also to mention that traders, in case of reversing position, need to put stops in order to protect their positions. So once when the long position is reversed, stop will be placed somewhere in the midpoint of the distance between the neckline and the top, and of course will be moved accordingly as the market continues to move lower. So it will protect and increase the existing profits that are going to be made if the market goes in desired direction. The next pattern that we are going to look at is head and shoulders pattern, also quite popular among traders. Is also a reversal pattern that indicates most likely reversal of the existing trend once the pattern is completed. So each pattern needs to be completed in order to confirm a signal that is indicating. Head and shoulders top is characterized by 3 peaks where the 2 ones from the sides are lower than the middle one. And the highest, usually the highest, the middle one marks the head, while 2 other mark the shoulders, and should be roughly at equal levels, but not necessarily. So if they are one shoulder higher or lower than the other one, this is also the head and shoulders pattern, and gives approximately the same strength of the reversal signal. It's just not, it's so-called asymmetric. The lows between these peaks are connected with the trend line, which again is our neckline and represents key support or resistance level to watch for a breakdown and the trend reversal. So what we mentioned on the double top and double bottom, the same rules apply here. So once the price moves below or above the neckline, signal is completed and the pattern is completed, and we can expect signal of reversal. There is another inverse shape of head and shoulders, mirrored one like double top and double bottom. We have head and shoulders and inverse head and shoulders. That is simply mirrored picture of the pattern just looks like a big W font and signals a reversal of existing downtrend to the upside. So we have the slides of the trends. So we can see head and shoulders pattern comes after the uptrend, first rejection to the upside, the bounce, pull back lower, fresh bounce higher, which makes higher high than the previous one. Another move lower, which approximately finds support at the level near the previous one, and then the final push higher, which usually stalls well below the middle high, forms the pattern. We have shoulder, head, and another shoulder. And then, of course, confirmation of the pattern comes on a break of a neckline. And again, same rule, distance from the highest to the highest point to the neckline. The expected move could be a length of the this distance or double the size. Inverse head and shoulders is a mirrored picture. As we said, the downtrend loses power at a certain point, bounces higher, reverses lower in attempts to continue the trend, but faces again strong support. And the final attempt higher is, and the second part, the attempt higher is again blocked at level close to the previous one, with the final attempt lower being rejected above the lowest point, with break of the neckline signaling that the downtrend is reversing to the uptrend. And then again, same rules of the length of the move could apply to this change of the direction. Next pattern are wedges. We have rising and falling wedges. The wedge patterns are generally reversal patterns, but not necessarily. Could apply also on continuation patterns, and we'll see them later on among those patterns too. It's rising wedge is a bearish chart pattern that forms when the trend is moving higher and the prices are converging and signaling that prevailing trend is losing strength, is losing momentum, so suggesting that something might happen, and the price, the trend would change its direction from original downside trend to the upside. On the other side, falling wedge is a bullish chart. The rising wedge is the bearish reversal, so uptrend will be changing to a downtrend, and the falling wedge is a bullish chart pattern that forms when the trend is moving lower and prices are converging, signaling that that bearish trend is losing power and momentum and is likely to reverse. So we have samples of rising and falling wedges. So we have in the first case, we have the uptrend that continues to push higher and forms slightly higher highs and higher lows, but the price is converging. So when this move starts to narrow, this is initial signal that something is developing, and the trend most likely is going to reverse to the downside. Falling wedge is exactly opposite. Downtrend is losing momentum, keeps posting a series of lower lows and lower highs, but within narrowing trend, and usually narrowing trend, which is also characteristic of triangles, could be signal that something is happening, and most likely the trend will reverse in case that wedges are indicating a reversal. But wedge also, as I said, could apply on the reversal patterns or on the continuation patterns. So it may indicate that the existing trend might be consolidating and regaining traction ahead of fresh continuation, higher or lower, depending on the direction of the trend. The second important group of patterns is so-called continuation patterns. These are the chart formations that signal that the current or existing trend will continue And they're also known as consolidation patterns. This is what I mentioned just slightly before. They show how buyers and sellers are taking a break, pausing their action before started moving in the existing direction, in the same direction as the existing trend was. So basically, it could be seen as a consolidation before the trend continues higher. Now, in this case, we have again continuation patterns which could the wedges could apply on this in this case rising wedge is downtrend with the price bouncing higher again, forming series of higher highs and higher lows, but within the narrowing trend price is converging, and break below the support line of this narrowing trend, which is in triangular shape, is signal that the price will continue lower in its original trend. Once it breaks the previous lowest points, we'll have confirmation that the pattern has been completed and the existing downtrend will continue in its original direction. On the other side, falling wedge is the uptrend that is taking a break, pausing under the fresh high as it was hit, and then certain corrective action was seen, or corrective or consolidative action was seen after that, with the narrowing range converging prices, signaling that price may reverse, as it was case in the reversal patterns, or continue higher. Break above the trend line that connects the series of lower highs from the highest point to the end will signal that a trend is likely to continue, and confirmation of the continuation of the existing trend will be generated on the break above the highest point of the previous rally. So once we break this level, we can consider that the price, the instrument will continue its original trend and continue to move up or down depending on the trend. In this case, it was the uptrend. Another important patterns that you can see in your charts are rectangles. So we have sort of looks like flag. There are another types of patterns that are called flags. So rectangle is similar to wedges, but the price moves within the same range, taking a consolidation of the initial move. So we had the trend up and then a series of waves that move within a certain width of the range, and most likely will result in the continuation higher once the price breaks above this line that connects the highest points, which is usually the horizontal line. So to form the rectangle will signal that the trend is going to continue after this consolidation phase. And on the other side, bearish rectangle appears when the downtrend takes a break. Consolidation is moving within two trend lines, could be defined by these two trend lines, and most likely the existing downtrend is going to continue lower once the consolidation phase is over. The length of the consolidation varies as we go, let's say, on the larger time frames. Consolidation may take some longer time, also depending on the various factors from fundamental side in the market when there is indecision and awaiting certain important releases. So the market may stay in quiet mode for a couple of hours, couple of days, or couple of weeks, possibly before it continues its larger downtrend, before continues its original direction. Again, depends on the size of the time frame. So larger time frames usually take more time to move, and they take also more time to consolidate or take a break. Pennants are among continuation patterns. It looks like a triangle and appears on both directions. So when you see the price moves in this shape and you can define they define it with the trend lines that connect a series of lows that each next is higher than the previous one, and series of highs where each next is lower than the previous one will signal the formation of a pennant, in this case a bullish pennant, and a break above the upper trend line resistance will be signaling that that direction is that the trend is going to continue after taking a break, and the bearish pennant is exactly the same but opposite direction. So the downtrend is taking a break within the narrowing triangular consolidation before it moves lower. A break below the trend line support is initial signal. A break below the lowest previous point will be confirmation that existing trend is going to continue in its initial direction. Now, what we spoke previous flags. So, flag is among the continuation patterns, and consists of the flagpole, which is usually happening during the stronger moves with the higher volumes, and then the price takes a consolidation after these strong moves. This is a quite normal situation in the market. After strong moves, there is usually a period of consolidation before the market regains traction and continues higher. In this case, continuation pattern is formed like a flag. So we have flagpole and the flag itself, which is slightly turned towards the downside in case of the uptrend, and could be also defined by trend lines connecting the highest and the lowest points, and a break above the upper trend line that defines the flag will be signaling that the trend is about to continue higher. So initial uptrend is going to continue in its initial direction. Bearish flag is exactly the same, just in opposite direction. So we have strong downtrend, usually marked by high volumes, a consolidation phase that could last, again, depending on the time frames and depending on the strength of the previous move, and final continuation lower once the price breaks below the trend line support would signal that initial downtrend is going to continue after taking a break for consolidation phase. Another one that is another shape that is popular, the pattern that is popular is cup and handle. So it's not seen as it is the red line shows, as the market doesn't move in the straight lines, but rather in waves. So we can draw the line and it will look like the cup while the price will be moving within the waves, but will keep this shape. So after the uptrend, the price takes a break and moves lower, consolidative corrective action that appears after the moves, but regains strength closely after initially losing traction, and regains levels that were seen before the highs, with subsequent further consolidation forming the handle of the cup, and before the price eventually breaks above these two highest points and continues higher, and it completes this shape. So cup and handle is one of the popular patterns, chart patterns that could show us and indicate that something will be developing in the market. In this case, we're talking about continuation patterns. So another popular continuation pattern we have just presented. And now, in addition to the chart patterns, we have candlestick patterns. We spoke in the previous class about candlesticks as the most popular and the mostly used tool in the chart, as the candlestick gives us the biggest number of information about movements in the market. We said that the candlestick has its body and the upper and the lower shadows, and it's colored. Usually the bearish candle is either black or red, so signaling that opening price was above the closing price. And of course, the length of the body of the candle signals the strength of that move, while bullish candle is usually green or white, and signaling that opening price was well below closing price, so the move was end of the candle was a bullish move, and of course the length of the candle's body signals the strength of whole move. So candlesticks are moving and forming certain patterns that could be also helpful. They build the patterns that predict basically direction once the pattern is completed. So every pattern needs to be completed in order to get a clear signal. Again, we have various signals from the candlestick patterns, and the main groups are reversal, continuation, or indecision. Now we have patterns that are a single candle, like hammers or doji candles, and we have those that consist of 3-4 candles and need some time to be completed. So depending on the shape of the pattern, it could be either reversal, continuation, or indecision. Indecision is one of the important events that happen in the market, and it's signaled by doji candle. So doji candle is the one that has a very narrow body, and upper and lower shadows vary. The length of the shadows is depending on the activity of the market, but what is the main message from the doji candle is that the market opens at certain level, moves to both directions, again depending on the market activity, but could move 50, 60, 100 pips depending, but closes again very close or at the same level of the opening price. So meaning that traders are clashing, buyers and sellers are clashing in the markets, and basically none of them is having more power to win and define a fresh direction. So indecision means that there is approximately equal number of buyers and sellers in the market, and the market stays in one place despite moving higher and lower during the period that candle shows. At the end closes in doji, and doji signals indecision. Usually daily charts, daily dojis and weekly dojis are quite important, as they signal the whole movements of a given period of time, in this case day or week, and end of the day in doji signals that current direction is showing indecision, not necessarily to be a reversal. It could be continuation, but at the moment is taking a pause until fresh signals will be generated. But generally, when you see doji candle, could be long leg doji like this one, or could be simple doji, but in both cases it shows strong indecision, and most likely that market is expecting some further signals in order to either continue or reverse. Another important from the single candle patterns are hammers and hanging man. It's basically the same shape, it's just depending in which direction it appears. So hammer is a price pattern in that occurs when the security trades significantly lower from the opening. So we have opening somewhere here and fall lower, but bounces back, and market closes much closer to the opening level than closer than to the lowest point, forming hammer. And when such a thing appears in the downtrend, this is initial signal that the market could be reversing. It's not giving a clear signal of reversal, but suggests that current move is losing momentum and it may reverse. So indicates some changes to be expected in the near term, but not confirmation that the change is going to be 100%. So this is in downtrend. In the uptrend, we have a identical type of candle, but it's called hanging man. So when it appears in the uptrend, again, we have indication that something is developing, and the market, the instrument that we analyze might be losing momentum, running out of steam, as we like to say, and some change of the initial trend can be anticipated. We will need to see further. We need to get further evidence of this, but we have initial signal that something is developing. So hanging man appears when the market opens at a higher level. During the trading period, drops significantly lower, but quickly bounces higher and ends the day the levels which are not far from the opening, so forming a hammer candle. So hammers are usually indicating that something is developing in the market, and we can expect some changes. Inverted hammer again comes as an indication that something could be happening in the market. This is a bullish reversal pattern and appears during the downtrend at the bottom of the downtrend, and it's basically warning of potential reversal to the upside. As I mentioned, it's important to mention that inverted pattern is a warning of potential price change and not a signal and of itself, and not suggesting directly to buy, but instead signaling that existing downtrend could change soon. We have the same shape like hammer, just inversed. So the market opens at certain level, goes slightly lower, but basically goes significantly higher, but loses traction, and the subsequent pullback returns to the levels near the close, with the extension lower on closing, slightly lower than opening price, or in case of the red candle, opens lower and closes higher, but not far from the opening price, forming a inverted hammer candle, which is, as I said, a signal but not confirmation that something is developing, and change of the existing trend could be anticipated in the near future. So we have indication that is warning us that something is developing in the market, so we can act accordingly and protect our existing position. Now we have engulfing patterns that are also important things and usually give a signal of changing of direction. In this case, we talk about bullish engulfing pattern, which is presented by two candlesticks. The first one is usually red or black with smaller body and showing the negative direction, so bearish trend. And the next day's action comes with the ends up in the larger, bigger than the previous candle body, which is opposite color, so in this case green or white, and completely covers, overlaps the size of the body of the previous day's candle, so engulfs the body of the candle. So that's why it's called the bullish engulfing. You can find it also as a bullish outside day. So daily action of the 1 day, daily action of the second day is much wider from opening to closing from the action of the previous day, which is in red. And this is initial signal that downtrend could change its direction and turn upside. Exactly opposite is bearish engulfing. You can find it on daily chart as bullish outside day, or weekly chart, which is the same thing. So we have in this case an uptrend which ends in the green candle. Next day candle is body of this candle is much bigger than the previous one, but it's in red, so opens higher and the closes lower, completely engulfing the previous day's candle. That signals that initial downtrend, initial uptrend is about to change. So we have an indication that something is developing in the market, and we can expect changes in the direction, so we can act accordingly and protect our position. There are plenty of more candlestick patterns that exist in the market. Also popular ones could be evening star or evening doji star, which are also reversal patterns. In this case, evening stars are bearish reversal patterns. Then we have morning stars and morning doji stars that are bullish reversal patterns. Then we have bearish reversal 3 black crows or bullish reversal 3 white soldiers. We're going to talk about these patterns in our coming sessions, as we have opened the big chapter of technical analysis, and it's going to take time to cover all the items of it. So we'll be going step by step and using analyzing part by part, so not to make it too complicated for our students. And this will be all for today's session.